All right, so everybody, welcome to Enhancing the Accountant Bookkeeper Connection series. Oops, that was just all of my information. If anybody wanted that for blog, Facebook, Twitter, LinkedIn, Instagram, YouTube, and Google+. And that is myself. For anybody who does not know me, I am Tanya Hiltz, a CPB, and the founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. So here's just a little bit about myself professionally. I was a top 21 influencer in the Canadian bookkeeping world for 2018, just announced last week in Calgary. I was also voted as one of the Insightful Accountant Top 100 Pro Advisors for 2018, a HubDoc Top 40 Cloud Accounting Firm for 2017, Intuit Firm of the Future runner-up for 2017. I'm a volunteer mentor through Futurepreneur Canada, a member of the Intuit Trainer Writer Network, a Black Swan alumni for 2017. So it started 2016, but finished 2017. I've got my CPB designation, Advanced Certified QBO Pro Advisor, Certified QB Desktop Pro Advisor, and over 20 years bookkeeping and income tax experience. A little about myself personally. My passions are my family, experiences, and I've just started to learn ASL. So these are just some of my favorite pictures of mostly my daughter and myself that we go out on experiences. If you watch TV or listen to Canadian talent, you may recognize some of these, just some of the cast of The Vampire Diaries, Supernatural, and Mary and Trench and Headley. And of course, there's my puppy, who I love my puppy, and there's the family. And we are featuring CATA Accounting today. So I've been collaborating with Jonathan and Bob for a number of years. We've got multiple mutual clients. They work in QBO, great attention to client detail, outstanding customer service. And I just really can't say enough about collaborating with them. So take it away, boys.
Thanks for a wonderful introduction. We're just going to get set up with the slides here for the presentation real quick.
All right.
Well, we might just mention that collaborating with bookkeepers is one of the things we love to do. It's part of our practice, and if anyone wants to connect with us, feel free to follow through on the addresses and information, and we'd be happy to chat with you.
Yep. I've learned so much in the time that I've been collaborating with them, and yeah, CATA is my number one preferred accounting firm when I've got clients who don't have an accountant that they deal with. CATA Accounting is the first name at the top of the list. So.
Well, thank you.
You're welcome.
I think a big part of our success is our first two values are communicate and collaborate. And that really, I think, makes a big difference, especially for the customers. So,
yeah, absolutely. I've not seen any of the accounts I've dealt with do not communicate and collaborate as much as you guys do. And it's great to see, which is exactly why I throw my name and reputation with my clients behind you, for sure.
So I'm going to tell you guys just a quick couple things about our firm. There are now 3 accountants and a bookkeeper working together. We have Bob and Larry Markland, and between the 3 of us, what are we at? I think we calculated 96 years of accounting experience, something like that.
We're working toward that 100.
I'm Jonathan Carter. Here's my lovely picture if you don't know me already. I was lucky enough to be a member of the inaugural Intuit Accountants Council, and I think that really gave me a leg up when I was starting out. We are a Platinum Pro Advisor firm and Intuit All-Star. We do respond to queries on the platform based by Intuit. Part of our goal with this series of webinars is to improve the overall quality of the industry. We've seen a lot of absolutely shocking things from bookkeepers that are just need to be improved. So this is kind of one of our ways of promoting ourselves and giving back at the same time. I have a lot of experience in mortgage industry, rental properties, e-commerce, digital and affiliate marketing. Those are the kinds of businesses that we tend to work with most of all. I'm also a member of the Japanese Canadian Cultural Center, and our Toronto Japanese Film Festival kicks off actually on Thursday, if anybody has any interest in the GTA. I also enjoy fishing and playing poker, but I'd rather play literally for peanuts with friends over some laughs and good days. So, Bob, why don't you tell us a little?
Sure. Greetings, everyone. Bob Hamilton. I, in my university days, took a master's degree in mathematics, and then saw the light from that and went to work with a CA firm. This was a number of years ago now. I hate to think about how many years it's been, but I was recently awarded a lifetime CPA award from the Institute of Chartered Accountants, so I'm pretty pleased about that. I did work for the Big Four CPA firm, left them and went into financial planning roles in mostly large companies, involved in development of some pretty complex models. I've worked in a number of industries, and then I started doing independent consulting work with different companies. I live in Georgetown currently, which is where we're broadcasting from, with my wife and our 4 cats. And I really love doing woodworking, and I love watching the stock markets.
Let's get right into it. A big part of what we talked about in our earlier seminars was the concept of Kiriath 13, all the close that has to happen at the end of the year. This is to provide the most accurate numbers possible for third parties, independent, especially lenders and owners who are relying on the results. And if the results are not bad, it creates a liability situation for all of us. So today we're focused on fixed assets. There we are. So, Bob, you want to take it away?
Sure. The agenda we're going to follow today is just a quick definition of fixed assets, a little bit about the difference between expensing and capitalizing. So that gets into the accounting, then talking about depreciation methods and definitions. We'll discuss purchasing property with a focus on splitting out between the land cost and the building cost. Talk a little bit about a fixed asset subledger, which is a ledger that will support the number you're carrying on your balance sheet. Then look at accounting for disposals, and this is a pretty complicated area, folks. You can get in pretty deeply, so we can't obviously cover a lot of those complications, but we will just kind of mention them.
All right, so basically, a fixed asset is something that's going to provide you a value over time. So you buy a new laptop for your business. You don't use that laptop for 1 year and then it's no good. It takes time. In practical terms, we have a word that we absolutely love called materiality. And the question is the asset worth enough, or is the cost of the asset enough to actually be capitalized? Different size of businesses will have different levels and different rules. Generally accepted from CRA is $500. Do you have any answers?
No.
So, just if you're in the chat, we'll follow up on this at the end. What's the most complicated fixed asset situation you have ever had to account? We'll look at that at the end of the slides.
Mm-hmm. So just to look over some of the words that talk about how you transfer the costs from the balance sheet into the income statement over a period of time. So the normal one is depreciation. When you think of your computers, your building, your automobiles, those are all tangible assets, and we use the term depreciation. to indicate the write-off of those into expenses. Amortization is similar, except it applies to intangible assets normally. So goodwill, patents, and non-physical type assets. Like if you've got an IT department, and that would be my example of one of the most complicated fixed asset situations I've had to deal with, where we had staff in 3 different countries, IT staff developing a new accounting process for a large insurance company. So we had literally millions of dollars. The rules for capitalization were quite complicated and difficult to kind of transfer to determine what should be capitalized. So amortization is those intangible items. Depletion relates mostly to the natural resources industry. So you would talk about the write-off of those in terms of depletion. And when you're dealing with tax matters, we talk about capital cost allowance.
All right. So what does a fixed asset cost? Let's say you buy a new machine for your factory. Is it just the cost of that machine? A lot of other costs associated with creating that asset to the point where it's usable can also be capitalized. The delivery, any fees to set it up, licensing, installation costs, various things like that. There are a lot of depreciation methods that can be used, and I'm going to use depreciation, amortization, depletion interchangeably here. We're going to try and use the word depreciation, but there's many different ways it can be tracked. Our preference and what we tend to do is we track it based on the CRA rules, which are a declining balance method based upon a certain rate. The date the asset was placed in the service is very important because that helps calculate the depreciation accurately. One thing that I do recommend, and we'll get into it further, is the use of a fixed asset register. There's nothing saying you need to have this, but trust me, it will make your life easier when you need it. So, Bob, this is a great example.
Yes. So when you're purchasing property, we've had examples of this with some of our clients. They buy a property and it consists of a building and the land the building is located on. It may also include some machinery and office furniture and that type of thing. So we really need to split those assets all into their separate classes, because they all have different depreciation rates or capital cost allowance rates for tax purposes. But the big one is really land and building, because land is not depreciable for tax purposes. They consider that land values don't go down, you don't use it up as time passes. So you really need to think about how you're going to value the land and the building separately. One suggestion we'd have is include it in the purchase documents. Make sure, like, have the vendor and the purchaser agree on what the split of the values are going to be, so it's well documented.
In the case where that's not available, one thing we have had some success with is getting a letter of opinion from a local realtor who understands the local market very well.
One of your good buddies did that for us.
Thank goodness. Thank goodness, yes. So let's talk about the fixed assets subledger for a while. This is one thing that Bob and I don't necessarily agree on all the time.
Jonathan's favorite topic.
I think this is very important because this gives you very, very detailed accounts of what you own, where it is, who's responsible for it, and where it is in the depreciation cycle. This will also help you write off assets as you dispose of things. Maybe they become obsolete, they break, or they grow legs and walk out the door. But without this fixed asset subledger, it's a lot of work to go back and figure things out after the fact. I think you just do it once, do it right. Every time you get that fixed asset over $500, It goes on the fixed asset subledger. You've got all your detail there, and it can make your life very, very easy down the road.
I agree with all of that. Jonathan and I had some discussion about that first sentence on the slide. Jonathan had it absolutely required, and then we kind of compromised on not required but recommended. So it can be very useful in situations where you have a lot of fixed assets, and sometimes things like laptops tend to grow legs and walk out the door. So to keep specific track of them is, in some cases, quite important. I will agree with that.
All right, so this on the screen here, I don't think we need to run through this in detail, is a basic example of how you dispose of a fixed asset. A lot of the times we're getting books from bookkeepers where assets have been disposed of, but the appropriate amortization and asset have not been removed from the balance sheet. Even though they're listed as a net of zero, they're still making it look like you have a lot more fixed assets than the business actually owns, and that they're just depreciated. If it ever came to the point where somebody was looking for those assets, say in a purchase or in a funding agreement of some kind, that could create a real problem, as it might appear that you're not tracking things properly, which is in fact the case. Do you have anything to add about these entries?
Well, the real key here is you want to compare the proceeds that you're receiving to the net book value, which is the asset value less how much you've depreciated it so far. So you really need to bring the depreciation into the picture, as Jonathan said. And the difference between those two numbers, of course, is a gain or loss on disposal of the asset.
This example, of course, is simplified because it's using a straight 5 years of depreciation. Of course, these examples can become much, much more complex. So, you want to talk about this one?
Sure. You want me to do the complicated stuff?
No, if you want. I don't mind talking about this. Okay.
These are some of the other issues concerning fixed assets where you can really get into more complex territory. Some of them aren't that bad. Like leasehold improvements is a little bit of a different animal because you're writing it off over the term of a lease, usually plus one renewal term if you do have a renewal term in the lease. So you have to accumulate the costs if you're building out a new office or something, capitalize them, and then write them off over a period of time. You can get tax incentives which lead to fast write-off for tax purposes. And in that case, you might be depreciating things differently for tax than you are in your books. And that gets you into deferred tax accounting. Yuck, we don't want to go there. That could be a whole other presentation.
In most cases, it's best to keep it as simple as possible.
Yes. Development costs, if you're doing a development, and by that I mean...
Website's a great example.
A website, yes. Building a new building, if you're using your own staff or paying a contractor to build a new building, you have to track those costs, accumulate them, and then when the building is put into use, and that can be a tough thing to determine, you might move into part of the building, but the rest of it is still being constructed. So you can get into some interesting situations in terms of depreciating those accumulating costs. And that's the next point, obviously. You can have assets where you've capitalized them at their original cost, depreciated them, but you suddenly, or perhaps your accountant determines that the value has been impaired. So your net book value on your books is too high for what the assets are really worth, say, in terms of a market value. So you might have to do a write-down in value on the assets. The other side of the equation is a revaluation where you write up the value of your assets. We were talking about land versus building a couple of minutes ago. land, normally you'd expect it to appreciate. And sometimes if you're going to the bank for a loan, they want to see a certain amount of equity in the company. So you may want to write up the assets so that improves the equity in the company, and then you qualify for a bank loan or something. So
Just to make sure you don't go out of bounds, I'd strongly recommend for impairment or revaluation or write up or write down, I definitely speak with the accountant.
absolutely, yes, yeah. Um, Especially if you're having an audit done,
Yeah.
you'll need to speak with your accountant. And then just to quickly mention, they're not fixed assets, but the intangible assets we talked about, like goodwill, and you might put a value on things like customer lists, patents, trademarks. I had one interesting example in a booze company, distilled spirits, where they had planned out a long-term marketing program. So I had never seen marketing expenses capitalized at that point. And when I saw them doing it, I had a big audit red flag raised. And I went to talk to them and they said, yes, they were going to run these advertisements over a period of 3 years. So they were capitalizing them and writing them off over that 3 year period. So when you have a cost that's spread over a number of periods, you can think about capitalizing it and doing the amortization.
This is very common on things. We talked about website development, but also, especially in software development, you're developing a custom built CRM program, something like that. This can also impact your ability to claim shred credits. But we're not going to get into
Shred.
that. What is it?
What's shred?
Oh, scientific research
And development.
And development.
Yes. So you get a fast deduction for those for tax purposes.
So that brings us to the end. Sorry for going a little over time there. As you can tell, we both have some passion for accounting. Yes, we're those kind of people.
And fixed assets.
Evidently.
Woo-hoo!
Are there any questions at this time?
I know none were coming in while you were going through, so people could just be waiting till the end. But while we're waiting for people to type, Bob, I had no idea you lived in Georgetown.
No?
I grew up in Georgetown. I
You're
don't like to
kidding.
admit it. No, I was actually born in Brampton, and back in those days, it was better to say you were from Brampton than from Georgetown. We moved to
Yeah.
Georgetown for grade 7, and my mother-in-law just sold her house down in the Glen. Yeah, I was a river rat. We lived in River Run.
Oh, wow.
So yeah,
Well,
how long have you?
we had lived in Mississauga, and we wanted to be a little more out in the country. So I guess it's about 20 years ago, maybe a little more. We found a place in Georgetown. It's a beautiful little town. Right after we moved here, I can remember going to the local farmers market and looking at my wife and saying, I feel just as if we're on vacation. So it has a real nice vibe to it.
Yep.
We love it here.
Allison's corn, most especially.
Yes, yes.
Yes, yes. Royal Pizza. Whenever we go back there, to Acton or to Georgetown to visit people, I always go through and I grab a rigatoni, a baked rigatoni to go from Royal Pizza, and their pizza is amazing. So if you have, I'm sure in 20 years you've probably had it at least once.
Yes, yeah.
Yes.
Jonathan and I are going to be having a meal together later, so
There's a thought.
maybe
I like that
we'll
idea.
think about Royal Pizza. That's a good suggestion.
You get more if you take it to go than when you eat it there. Just a little tip.
Oh,
So my
so-
mom always used to take us in and she'd order it to go and then it would come out. She'd say, "Oh, that was quicker. We'll just eat it here." So yeah,
So
you get
Tanya,
almost
let me
double.
ask you, what's the most difficult fixed asset situation you've encountered?
Um, Really, you know what? The only time is when you're dealing with a client who we have a mutual one that as soon as I tell you this, you will know exactly who I'm talking about, who decides to depreciate in a different way. They decide that they want a straight line, or I just use CRAs. Um, depreciation formula because they figure if CRA is going to come in, they can't argue with their own formula and their own percentages. Um, But I'd say when you've got a client who is used to doing it a different way, or you know what, the one thing that I really wasn't aware of, I don't think until you, and it's not that I hadn't come up with it, just nobody took the time to tell me, was that the legal fees or incorporation costs are considered as assets and depreciated. The
Hmm.
legal fees to
And the
incorporate.
rules and the rules about that literally just changed last year.
Yeah.
Oh, okay, well
So,
maybe that's why then.
well, no, it had been on the books for a while. It's was it cumulative eligible capital is the category of asset, of
Right,
intangible asset, and just the rules about how it can be depreciated changed last year. In the past, you could never fully depreciate it.
right, right, okay.
75%.
Right. Yeah, see, that would be it. And then I guess really the most complex, I was depreciating a building. So it was just kind of like getting into, okay, where does it fall based? Because of course, the percentages based on the building is, of course, based on, part when the building was built and what the materials are. So I found that a little confusing for my first time getting into it, just to try to figure out, exactly where it falls because there's so many different ones. Otherwise, I mean, the one that gets that I still have to go back and double check, to be honest, is generally the computers because they change that so often. There was when they came out with it for that 1 year, great, we'll give it 100%, and no, we'll do it to 50% and 45%. That goes all over the place. So that's one that I always double check myself just to make sure, okay, are we in the right one? Are we in the right one?
And
Um,
again, with the fixed asset register, you could have different computers within that class that need to be
yep,
depreciated at different rates.
exactly, depending on when they're purchased. Exactly.
All right,
So
well,
yeah, so that's what I find that's really what I find the most confusing with them basically. So I don't know if anybody else has any other ones. Nobody's put in chat,
I'm
so
just
maybe
going to
not.
throw one more quick comment about the depreciation of buildings when it comes to rental properties. That depreciating a building decreases your adjusted cost base, which means you pay more capital gains tax when you sell the property.
Yep,
CRA generally doesn't mind if you pay more tax, so they will allow you to not depreciate it. But you can't pick and choose. Once you picked away, once you started depreciating, you have to depreciate.
yep,
But just that's something out there that's pretty easy that a lot of people can.
yep. I actually only did it the once, and that's because they insisted and they knew. So I went, okay, who am I? And their reasoning was is it was a rental in an area that did not get the growth, so it was not going to appreciate that much because it was pretty their real estate market was pretty stagnant.
And in some
So
cases, you are barred from taking depreciation on rental properties because if you create a loss, a rental loss from taking depreciation, that can't apply against other income.
that's right.
So you can't create a loss by taking depreciation, basically.
Yep.
Not for a non-incorporated company.
Right.
Okay, so were there any questions? Any other people want to talk about a tough fixed asset experience they had?
So far, it's a quiet bunch today.
Okay, well, unless you have any more questions, Tanya, I think that's it for us.
All right.
We're
Nope, that's
good.
it.
Yep.
All right, perfect.
All
Well,
right.
thanks everybody for coming. The recording link to this will go out tomorrow. And then, of course, a brief questionnaire. So please take the time to fill that in because within that brief questionnaire will be if you've got any other topics that you'd like to see. So if it's a topic maybe that what happened earlier on, we can certainly, like that Bob and Jonathan did earlier on, I can certainly send you a link to that. Or if it's for future topics, definitely let us know and I will pass that along.
Thank you.
Sounds
Okay, great.
good.
Well,
Thanks,
thanks so
Bye,
everyone.
much.
everyone.
Okay, have a great day.
Okay,
Bye.
Tanya.
Bye.